Alright, welcome back to my channel. Today we are diving into the ultimate guide to investing for beginners. If you have got some hard-earned cash saved up and you are wondering where to put it, you are in the right place. Let's get started. First one, we are all going to discuss about philosophy of investing. So, why invest? Well, the fundamental point is to make your money work for you. Imagine you have saved up $1,000. You could stash it under your mattress, but with inflation on the rise, your purchasing power diminishes over time. Investing is the key here. It's like planting a seed that grows into a money tree, combating the effects of inflation. But how does the magic growth happen? The philosophy boils down to buying something now that generates more income over time. Take a house, for example. You can rent it out, earning monthly income. Plus, the value of the house may appreciate over time. This dual benefit counters the erosion of savings due to inflation. However, not all assets have the dual advantage. Some, like stocks and shares, rely on selling them for a higher price later. We'll explore this more shortly. Now, the investing world is vast and varied. We have got stocks, shares, equities, hedge fund, index fund, government bonds, corporate bonds, watches, fine art, crypto, and many more. It can get overwhelming, but for simplicity, we'll focus on stocks and shares, the go-to for many regular investors. Unlike real estates, you don't need a fortune to start, and it's not as complex as some other investment avenues. So, why the focus on stock and shares? Because they are accessible and can be a great starting point for beginners like you and me. Now, the part 2 is why and how to invest in stock and shares. Let's dive into the nitty-gritty of investing into stocks and shares. When you invest in a company, you are essentially buying a piece of the company. Imagine you want to be on slice of Apple. You can't go directly to apple.com/buy. That is, you need a middleman, a broker. Once you go through this broker, you'll become a proud owner of percentage of Apple. Now, how do you make money from these stocks? There are two main ways. Firstly, you can earn profit if the stock prices increases over time. Buy low, sell high. This classic strategy. Secondly, some companies pay dividends. These are like rental payments of your ownership. For example, British Telecom (BT) pays out dividends to its shareholders. So, owning a piece of BT not only gives you potential for capital gain but also a share of company's profit in the form of dividends. But here's the $1,000,000 question. Which stock should you choose? Warren Buffett, a legendary investor, suggests that unless you are a full-time financial professional, avoid picking individual stocks. The average person lacks the expertise to consistently pick winners. Instead, consider a more straightforward approach. Now enter index fund, a game changer for beginner. An index fund is a basket of stock or other assets that tracks a particular stock market index. For instance, the S&P 500 is a well-known index in the US consisting of the top 500 companies. By investing in an index fund, you are essentially buying a piece of all these companies, diversifying your investment. Why index fund? Well, they offer simplicity and diversification. You are not betting on a single company's success. You are betting on the overall success of the market. It's like a long-term strategy that's aligned with the philosophy of letting your money grow over time. Now, attempting to pick individual stock can be challenging. Studies show that very few funds consistently outperform the market. Even if a fund beats the market one year, it's unlikely to repeat the success the following year. So why not cut out the complexity and invest directly in the market? Now you might be wondering, how do I invest in an index fund? You'll need an online investment platform or broker. Platforms like Charlie Stanley Direct, Vanguard, or Trading 212 allow you to buy and sell stocks and invest in index fund. That's wrap up of part 2, why and how to invest in stock and share. Remember, simplicity often wins the world of investing. Now in the part 3, I am gonna address some common fears and concerns about investing. So okay, one major fear is a fear of losing money. While it's highly unlikely that Vanguard or the entire stock market will collapse overnight, the value of the investment can fluctuate. If the market experiences a downturn, the value of your investment may temporarily decrease. But here's the key, it's a paper loss until you sell. If you hold on to your investment, history shows that markets tend to recover over time. Take the 2008 financial crisis as an example. If you invested in the S&P 500 just before the crash, your portfolio would have taken a hit. However, if you hold on to it by 2012, you would have likely recovered your loss, and by now, you might have doubled or tripled your initial investment. The market tends to move upward over the long term. The chances of all 500 of the biggest US companies dropping to zero overnight are practically zero. These companies are continually creating value through innovation and productivity. Investing in an index fund like the S&P 500 means you are betting on the overall success of these companies, not just one. Another common question is how much money is needed to get started. The good news is that you don't need to be super rich. Platforms like Vanguard allows you to start with a little as £100 or even £5. Depending on the platform and country, do some research to find reputable platform in your region. Apart from stock and shares, I also invest in real estate and crypto. However, these are different beasts and might not be within reach for everyone. Real estate usually requires significant initial investment, while crypto can be more volatile. If you are considering crypto, be cautious and only invest money you can afford to lose. In the end, the key to approach investing with a long-term mindset. It's not a get-rich-quick scheme, but a gradual process of letting your money grow over time. If you have any concern or question about getting started with investing, drop them in fine comment. I'd love to hear from you. Now, in the part 4, we will explore fast lane investing as an alternative approach. Everyone, so far we have discussed about some slow lane call approach to building wealth through traditional investment like stock and share. Now let's explore the alternative, the fast lane approach. The concept of slow lane investing is often associated with strategies like regularly investing in index funds such as S&P 500 and patiently waiting for compound growth to accumulate wealth over the long term. The idea of fast lane comes from M.J. DeMacro's book, The Millionaire Fast Lane. Instead of investing in someone else's business, like buying stock of established companies, fast lane investing involves investing in your own business endeavors. Fast lane investing in yourself means putting money into your education or skill that can significantly boost your earning potential. For instance, taking a course or gaining a certification that open a new career opportunities. By increasing the value to the market, you are potentially achieving a much higher return than the average annual growth of the S&P 500. The other aspect of the fast lane investing is putting your money into your own business ventures. If you have a business or plan to start one, the approach can yield substantial returns. Building a successful business can lead to financial independence much faster than relying solely on traditional investments. The concept of getting rich quick is often associated with schemes and scams, but when it comes to building wealth rapidly, business ownership is a legitimate path. If you can successfully own and grow business, the potential returns are far beyond what traditional investments might offer. As an example, if you are interested in investing in your own education and want to take your YouTube channel seriously, exploring a course might be beneficial. It's designed for those looking to treat their YouTube channel as a business, focusing on systemizing and scaling their profitability. In conclusion, while traditional investment like stock and share are a valid approach, fast lane investment encourages you to look within and leverage your own skill, education, and entrepreneurial spirit to accelerate wealth building. If you want to dive deeper into the fast lane philosophy, check out the book The Millionaire Fast Lane by M.J. DeMacro, or else I am going to review this book in some days. So, thank you so much for watching. If you found this video helpful, consider sharing your thoughts in the comments below and consider sharing this to your friends, as this is a new channel. I want to grow, okay? And give you the best insight possible on YouTube. Alright, so I'm gonna see you in the next video. Till then, subscribe to this channel if you are new, and thanks.